Hello, welcome to Accounting Hub. I'm Professor Dart Scarpin, PhD in accounting, and our topic today is one more video about financial statement analysis, about liquidity ratios or ratios that work with the company's risk. And the other videos of financial statement analysis, they are in our video description, as well as, let's go here, the financial statement of Coca-Cola, that is the company that we are working with. And a disclaimer here, we are not working with any classified information. If you go on this link here, you will find the our numbers, and this link is also in our video description, as well as the Excel file that we will be working with. Okay, so these are the risk ratios of liquidity. The first two ratios is about accounts receivable. The first one, the turnover ratio. How many times do we receive our accounts receivable per year? For instance, if this number is 12, so we receive it 12 times a year. And then we translate it in number of days, that is average collection period. 365 days, if we are working with annual statements, that is usually how we work with, divided by receivables turnover ratio. If we are working about quarters, then the turnover will be the turnover of the quarter, and then we divide it by 90 instead by or 92 or so. That depends on the quarter. So that's why we usually work with year. So 365 days. And it doesn't matter if our year is the special year where we have 366, we usually work with 365. And usually the companies, they don't disclose the credit sales. So if they don't do it, let's work with the net sales. Because okay, it's better a not so accurate info than no info. Okay, so first of all, let's work with these two first ratios in our Excel file. So our Excel file, I copy and paste this our PowerPoint here because it's much easier if you are working only with the Excel file to remember. And here we have the financial statements and the vertical and horizontal analysis, that is the topic of a previous videos, and also ratios for solvency and profitability. So all of our four videos, we are working with the same Excel file. It's much easier for you guys. So let's do it. Receivables turnover ratio, net credit sales. We don't have it, so net sales. Income statement, net sales. This one in 2019. Divided by, let's come back here, average accounts receivable. So the average accounts receivable is parentheses, accounts receivable, balance sheet, accounts receivable. We always work with the net numbers. That is accounts receivable less provision for doubtful accounts. This one, 2019 plus 2018 divided by 2. So here, 2.43. So this is our turnover. Let's double check here. Let's add one more parenthesis here. One more parenthesis there. Okay, now it's much better. Accounting is easy. Basic math kills us. So I will do the formula again. Okay, it is easier. And let's rename it. That is the name that you already have. So income statement, balance sheet. Okay, that is good. Equal net sales divided by double parentheses here. 2019 plus 2018. Close the first parenthesis here. Divided by 2 because we are working with the average number. Close the second parenthesis there. So Coca-Cola received their accounts receivable almost 10 times per year. So the average collection period will be between 1 and 2 months here. So a little bit more than 1 month. So let's do it. 365 divided by turnover. 37 days. So here, average turnover rate. When we talk about turnover, we are talking about times. How many times? When we are talking about period, we are talking about days. Okay? Let's copy and paste this formula here. And it will not be possible to copy and paste this formula because here we have the vertical analysis here. So we will not be able to copy and paste the formula. So we need to do that again. 2018 net sales divided by double parentheses accounts receivable 2018 plus 2017 divided by 2. And it is not possible for us to have this ratio for 2017 because we will not be able to work with this average. So that's why usually we work with 3 years of data and 2 years of ratios. Okay? And it is 3 times. So a huge decrease here. So why we are decreasing this number so much? Let me double check it. Wow, we don't have the horizontal analysis here. So let me do it. You already have in your file, so let me do it here. Whoop. Let me delete some bad numbers here. Okay. So here, what do we have here? 2018 decrease, small decrease. Accounts receivable, huge increase here. So yes, maybe we have this number is already right. Let's do it again. Net sales 2018 decreases. Our net sale decreases here and our accounts receivable increases. So, okay, so first of all, whoa. This one plus this one here divided by 2. And whoa, now it's much better. It was not a huge decrease. So 9 times 39 days. We are a little bit better here on the collection, but it is very stable number, so we don't have a huge difference here. The same math for accounts receivable, we will do it for inventory. Our ratio, so inventory turnover ratio. Cost of goods sold divided by average inventory. It is how many times we sell our inventory per year. How many times do we renew our inventory per year? And then how many days our goods stay in inventory. So let's do it. Inventory turnover, the same formula, but not working with sales. We work with cost of goods sold because remember financial accounting. We have inventory, and when we sell it, it goes from inventory to cost of goods sold. Okay, so inventory, cost of goods sold, or they also call it cost of revenue, divided by double parentheses, inventory, which one? The total. So total 2017 plus total 2018 divided by 2 is our average. Let's close the second parenthesis. And we have 4.53. So we have 4 times per year. And that makes sense. That makes a huge sense here. And let's do it for 2018. Cost of revenue 2018 divided by parentheses. Balance sheet total inventory 2018 plus 2017 divided by 2. And we have 4 very stable as well. How many days? 355 divided by turnover. And here, wow, why it is green here? No, ignore error. It is not an error, Excel. Don't mess with my Excel. So here, we renew our inventory 4.5 times per year. So our soda stays 80 days in inventory. That is not a huge number because we are combining raw materials, work in process, and finished goods. So all of my production and selling is 80 days and 79 days in 2018. So they are almost the same. And then maybe the two most important ratios that we have. So, okay, you have only 2 minutes to analyze a company. Work with, especially the first one here, the current ratio. Is the ratio where we work with our working capital. Working capital is current assets less current liabilities. Current ratio is the same, but current assets divided by current liabilities. So let's do it. Current ratio, current assets, so balance sheet, current assets divided by current liabilities. Where are you here? Current liabilities. 0.75. Very, very bad number. Usually below 1 is a bad number here. Why? How do we analyze it? Asterisk, asterisk. Uh, Coca-Cola has 0.75672 current assets for 1 current liabilities. So, okay, we have more liabilities than asset. That is not a good one. That is not a good number. And 2018, let's double check if we are better or worse. Current assets, 24, divided by current liability, 28. We were better in 2018, not so good. So let's consider here. Our grade could be a C. Now we have a D. So not so good here. So it is not in terms of times or days or percentage. It is all about money. How much money do we have for current assets comparing with $1 of current liability? And then the acid test ratio, that is basically the same as current ratio. However, we don't work with inventories. There are some textbooks that they present this formula here as current assets less inventory and less prepaid expenses. But this is the most current one. And the acid test ratio is also called quick ratio. So you will find in some textbooks the quick ratio. And here, guys, It doesn't matter if we are talking about US GAAP companies in the US or IFRS companies in any other country. Our ratios, they are exactly the same. Okay, so let's do it. So, okay, if we have no inventory, how much money? This is our fast money. That is why it's called it quick ratio. Is everything that is already money or it will be money in the short term. That is the accounts receivable. So here, let's do it. Cash plus short-term investments. We have them combined here. So, okay, plus receivables, total receivables, divided by current liabilities, 23. 0.56. So not so good. So how do we analyze it? Double asterisk, double asterisk. Coca-Cola has 0.56, 152. Cash plus current or short-term investments plus accounts receivable for one current liabilities. And let's move the picture here. So, okay, if we don't consider inventory, their number, it is bad, very bad. And the asset test ratio for 2018, let's compare it, how good we are. Parentheses here, cash 16 plus receivable 3 divided by current liabilities here. And we have 68. So we are going down. So Coca-Cola, you are not so good for your liquidity. You are not so good here. Okay, guys, so this is the liquidity analysis. And thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. Like this video as well. And please, if you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.